If you want to stash away $69,000 of your business profits as a tax write-off, you should consider a tax strategy of a solo 401k. In this video, we're first of all going to define what is a solo 401k and who is it good for. Then we're going to talk about how to use a solo 401k, whether you have a sole proprietorship, an LLC, or even an S-corporation. Right after that, and stay till the end, because we are going to talk about how to use your solo 401k to grow your money there completely tax-free. Ready? Let's dive in. Hey, thanks so much for watching this video on my YouTube channel. My name is Boris Musheyev. I'm a CPA and a tax strategist. Every week, I release a tax strategy video here on YouTube. For you, the profitable business owner, my goal is to completely simplify this tax strategy so that you can understand it. At the same time, you're able to go ahead and implement this tax strategy, or at least take it to your accountant so he can implement it for you. But if you don't have a tax advisor, you gotta get yourself a tax advisor so these tax strategies could be implemented for you in your business. Thank you so much. Don't forget to subscribe if you love the video. Let's go ahead and start saving you money on taxes. Perfect, let's get started. Now, first of all, before we use the solo 401k as a tax strategy, we really need to understand what is it for, how does it work, and who's it really good for. Now, solo 401k, the name kind of speaks for itself, right? It's for the solo owner, one owner. Now, you could have multiple owners, partners, for example, or your spouse could also be a partner in your business or own it together with you. Solo 401k will work in all of these situations. When solo 401k does not work is when you have employees. As soon as you get employees, it automatically gets disqualified. So you want to make sure if you are an owner or you have partners or you've got spouse in your business, you might want to start considering using a solo 401k, because solo 401k can really give you a $69,000 tax write-off in the first year. Now let's talk about setting up a solo 401k. Really, there's two types of retirement accounts that we have. One of them is called a traditional. Think about it this way. Whatever money you're putting away, you're getting a tax write-off, which is exactly what the solo 401k is. You get a tax write-off, but at the time of retirement, whatever your retirement account is going to earn, you're going to pay taxes not only on the contribution, but also on all the distribution. You can also set up your solo 401k as a Roth 401k. And this is what we're going to talk about towards the end of the video. In the Roth 401k, any money that you put into the Roth 401k, all of that money is not tax deductible, or some of it could be tax deductible, depending how you structure it with your tax advisor. And at the time of retirement, it will be tax-free to you. So we've got two options: traditional solo 401k and a Roth solo 401k. Both have different functions, and that's exactly what we're going to talk about. But right now, we're going to cover a tax strategy, how solo 401k works as a tax write-off, whether you're an LLC, S-corporation, or a partnership business, right after this break. Hey, thank you so much for watching my videos so far. I wanted to give you a heads up. I've got this free PDF, 7 tax write-offs that every S-corporation business owner must know. The link to this free PDF is down below in the description. So to make sure to download it, that's it. Now let's get back to the video. Awesome, welcome back. Now let's talk about solo 401k as a tax strategy. Like I said, it doesn't matter if you're a sole proprietor, an LLC owner with a partner, or an S-corporation owner. Solo 401k can be used for all of these three entities. Let's start with a sole proprietorship. Now, what is a sole proprietorship? It is not a corporation. It is not an entity. It is reported on your personal taxes. When you're a sole proprietor, you don't take out any salary from it, because everything gets reported on your personal taxes on a Schedule C of your 1040 form. Now, the IRS says, hey, if you're a single owner of that business, which sole proprietorships are usually single owner businesses. So the IRS says, if you are a single owner of that business, what we will allow you to do is put away $23,000 into your solo 401k. On top of that, you have to take a net profit of your sole proprietorship, okay? Take net profit of your sole proprietorship and put away 25%. That is a business contribution. So let's do a quick example. You have a net profit, meaning to say, after deducting all of the expenses, $100,000. Now you, as an owner of that business, can put away $23,000 plus 25% of $100,000, which brings up your total contribution to $48,000. Now you might say, well, Boris, you said that, I can put away $69,000 into solo 401k. That's true. What's limiting you to put away the $69,000 is that net profit of $100,000. Now, in order for you to maximize that solo 401k, the net profit in your sole proprietorship should be $184,000. But when you have a net profit of $184,000 in your sole proprietorship, you should not be a sole proprietor, nor should you be an LLC single owner member. What you need to be an S corporation, and that is why it's important for you to always speak to your tax advisor. When is the best time for you to be an S corporation? How much salary should you pay so that you can properly calculate your solo 401k contribution to get a maximum deduction? Now, let's talk about a tax strategy where you are an S corporation, you're taking a reasonable compensation, and how your solo 401k contributions would work. So, same example, okay, you've got $100,000 in your S corporation. $100,000 in your S corporation, let's say that is your net profit. Additionally, you took out $100,000 W-2. Now, with an S corporation, the net profit no longer matters. What matters is your W-2. So the IRS says you can put away $23,000 from the W-2 that you take from your S corporation, which is your reasonable compensation, okay? So $23,000, is a deferral, which you put away into the solo 401k. On top of that, you can take 25% of your W-2 salary. So in our example, we got $100,000 salary. So again, that brings your contribution to $48,000. But because you are an S corporation owner, you can actually take a look at your compensation and make a decision with your tax advisor. Should you increase your compensation to $184,000 to get a maximum write-off into your solo 401k, which will bring you up to $69,000. Now, if you're over the age of 50, your contribution goes up to $76,500. It's a big difference. So strategizing with your tax advisor is super, super important, because as an S corporation owner, first of all, you got to pay yourself a reasonable compensation. Maybe in your case, the reasonable compensation is $100,000, but your tax advisor could come up with strategic ways to say, hey, we can actually increase your reasonable compensation if it makes sense on the tax-wise, okay, so that we can maximize your solo 401k contribution. Because remember, as an S corporation owner, you can maximize your solo 401k contribution to $69,000. You're going to be putting away $23,000 from your paycheck, right? Whatever paycheck you get from an S corporation, $23,000 goes into solo 401k. On top of that, 25% of your W-2 will go into your solo 401k. Now that we have identified this tax strategy, let's go and talk about how you can establish a solo 401k, which is a Roth solo 401k, and all the money that you can contribute can be tax-free. We'll be back right after this break. Hey, thank you so much for watching my YouTube video. Just a quick commercial break. If you like what you see, please like the video. As a matter of fact, share it on your YouTube so that you can help other business owners to save money on taxes. I would also appreciate it very much if you subscribe to my video. If you like, share, or subscribe, it really helps me with YouTube algorithm, where YouTube will really push this video to other business owners and they can learn how to save money on taxes using simple tax strategies that I teach with my whiteboard strategy. Thank you so much, and let's get back to the video. Awesome. Now let's talk about how your solo 401k can grow tax-free. Remember what we said about solo 401k? It is for owners only, like one owner, two owners, or you've got a spouse in your business. That's not a problem. So you can actually control how you can and where you can contribute their money. Now, solo 401k can also be set up where you do not get a $69,000 write-off, like we've talked about earlier, but all the money that you put away will be after taxes. And that means all the money in that solo 401k is going to grow tax-free. So in our previous example, we talked about, let's just take an S corporation owner, $100,000 W-2 salary. we'll take a 25% of that. That's a $25,000 contribution. Plus, assuming if you're under the age of 50, another $23,000, which is deferred from your W-2, that is a total of $48,000 contribution. That $48,000 will not be a tax write-off. But when you invest it in wherever it is that you're going to invest it, your solo 401k, everything over there is going to grow tax-free. Now, you can also have an option where the $23,000 of your salary, which is deferral, can be a Roth IRA contribution after taxes, which means it's going to grow tax-free. But the 25% of your W-2 salary, that could be a write-off. You could really get the best of both worlds, and you can balance it out for yourself. The other amazing thing about this, setting up a solo 401k, is that you can also set up a self-directed solo 401k. What self-directed means is that you don't necessarily need to give it to a financial institution. What you can do is invest the money yourself, wherever you want it. That could be securities, stocks, Bitcoin, real estate. As a matter of fact, solo 401k are best for self-directed real estate investments. Of course, seek a professional advice, hire a company that actually handles this, and where you can open up a solo 401k and contribute it with them. I personally have a client who have done it on his own without the help of a professional, just Googled it before working with us, and he was over contributing, didn't know how much money is being taken out of his bank account. Definitely do not do that. It's a great strategy to use. It is actually not complicated at all. First of all, what you need is a tax strategist, a tax advisor, somebody that can tell you, hey, this is how you can set it up and this is how it could work. Then you hire a professional that can handle your self-directed solo 401k money, put together the proper paperwork for you so that you can legally and be in compliance when you invest in real estate, stocks, or cryptocurrency. Solo 401k is a great tax strategy. It can give you a write-off up to $69,000, or you can choose not to take the entire $69,000 write-off. Instead, invest it in a Roth solo 401k where your money is going to grow tax-free. Even better, you can do a self-directed solo 401k. All of these options are available to you, the business owner. What you need is a tax strategist. Make sure you speak to a tax advisor. Do not speak to your tax preparer, because your tax preparer is just putting the right numbers in the right boxes. They speak to you once a year. This is something that you need to do with a tax advisor. Thank you. Until the next time.